Hello, and welcome back to my YouTube channel. James here as ever for today's ACCA Financial Management F9 video, all about the External Examiner's Report, reviewing specifically the Section B analysis, going through some examples, and reviewing the notes that the External Examiner is trying to get across to students to help them pass their examination. My name is James. If this is the first time you've ever clicked on one of my videos, I'm an ACCA qualified member and tutor from the UK, and on my channel I help out ACCA students pass their examinations for free. So if that's of interest to you, make sure you hit the subscribe button below, because I dedicate as ever all my videos to my lovely subscribers. Today is no different. Have a look up above. This is dedicated to you, my friend. It's going to help with that revision plan. So let me know if you've got any questions in the comments like that I can help you with, or any video requests. Also, feel free to give the video a massive like and thumbs up. As ever, I really appreciate all the support for the channel, and it means that more ACCA students can see my videos to help them get the 50 plus, to get them over the line on there. So the link for this video, for the actual document, is in the description of the video, along with all the recommended texts that are all up to date to help you pass, so feel free to check those out on there as well. But without any further ado, let's start to walk and talk through, and make sure you stay to the end of the video, because you'll be smiling just like this lady, and you'll be looking forward to your FM exam, of course. First of all, we go through the actual general comments, nice and easy on here. They rattle on about the actual CBU practice platform being absolutely critical to students passing this examination. If this is the first time you've watched any of my review documents, everything underlined, if you want to take some screenshots, are the key elements that I picked up from the external examiner. And finally, maybe this is the first time you've actually looked at FM, but the Section B is actually 30 marks on there. You've got 5 objective test questions that are linked into 3 cases, so 30 marks overall. And to be honest with you, as we flick down to the comments that are going to be really helpful for you, lots of financial management students that I speak to say that Section B is the trickiest part of this exam, near enough with Section C. But again, feel free to let me know in the comments below if you've attempted the exam before, and to help out other students on there. So for the 30 marks, this is where, for your notes, if you haven't got a pen and paper already, it's 54 minutes in the exam and no more. However, the caveat to that is, if you've watched the Section A video, lots of students actually take minutes out of Section A. They find it a bit easier, and they allocate it to Section B. So I know some students that take up to an hour on this, maybe an hour and 5, but to be honest with you, Section C is so tough as well. You need to be aware of it. The key topics underlined as we go through on here, for the actual example we're going to have a look through now, is all about business valuation. Don't miss out as well, this is where the examiner puts in key information in the exam, right up at the top that you can see here for Daswin Co. It's a listed company on a large stock exchange, so quite complicated, lots of rules and regulations. They're not just a little sole trader on there. And for the example, again, you can watch it through yourself and read it through. The document links at the bottom. You've got the revenue, you've got profit for the year, we've got some corporation tax, equity and liabilities on there. But interestingly, no assets. So this automatically tells me we've got something to do with probably capital structure on there, or actual shares. Now, as we go through the actual requirements, you've been given irredeemable shares, preference shares, but as ever with financial management, this is where you've got to really read it carefully, make sure you get the correct units on there, and not to make any silly mistakes when we actually calculate it through. So identifying the key amounts and values is going to be absolutely critical, and again, you can have a look through this yourself, but I want to make sure you get down the key formulas, because some of them are not given to you in the exam and some are. Now, for the market value of the preference shares, first question on there, you'd be thinking, oh my word, if we got this in the exam, this would be a delight. So this is where, if you want to jot it down in your notes, and again, I'll put the answer on the screen, so $7.50 million on there is the market value of all of those preference shares. And what we're saying there is the preference dividend is equal to 50 cents multiplied by the 6%. So that's the nominal value multiplied by the irredeemable rate. So that's the preference shares figure. And then finally on there, to actually get the preference share value per share, this is a formula not given to you in the exam. Take that preference dividend that we just calculated before, the $0.3, and divide it by the preference share cost of capital. And that is where we're going to get 0.375. We're going to take that figure further down here, and then another formula for you to get into it as to say, well, how do we calculate the number of shares? We've got the preference share capital divided by the preference share nominal value, and then we can calculate to say, right, how many shares have we got? What is the value of one of those shares? Multiply them together, and that's where we get the $7.5 million. The external examiners kindly put on here the most common error, and this is where we take the nominal value of the preference shares to be $1, and you get an answer of 3.75 on there. So that is where we actually need to calculate our own market value and multiply it by the total number of those preference shares. That is really key on there. Not the nominal value, we need the market value. That is where you've got to read the question carefully. Coming on to question 2, and again, feel free to screenshot, take down any notes, pause the video, whatever works best for you. Using the price earnings ratio method, what is the value of DasVinco? So the answer was 40.8 million on there, but how did we get to it? So as you can see just above me, we've got those preference dividends again, the 10 million multiplied by the irredeemable rate. Then we've got to say, from that, we've got the earnings for equity after the preference dividends. So 4 million is the profit for the year, minus those preference dividends, and because it's a preference dividend, we have to pay it out every year. That's the risk that they actually have bared, so that's the return we have to give on an annual basis. Finally, that's where we actually have our profit for the year after those preference dividends, giving us our price earnings ratio value of the 3.4 million carried forward, as you can see, multiplied by the 12, the PE ratio, which we calculated above, or we're given in the question above, and that is where we get our 40.8 million on there. The common error for you to get down in your notes is you have to pay the preference shareholders' returns. So that is where not to deduct the preference dividend before taking the earnings figure on there. So, and instead using the earnings figure of 4 million and getting 48 million as a result. So just have a look back at the question up above. I want to just keep rolling through. It's just so you can pick up on what the external examiner was saying for those most common errors. Nicely rattling on now to question number 3. So based on the current ordinary share price, notice how I'm only underlining and identifying the key facts and figures, were $2 per share. What is the market value of the convertible debt of DasVinco? So again, we've got an answer here of 21 million on there for it. So you've just got to work it through line by line as ever and have a look back at the requirement as to where we got these figures from. The key formula for you to get down on here for the conversion rate, first of all, is the ordinary share price, so you've got the $2 on there, multiplied by 1 plus the growth of the stock market to the power of the number of years, so these little details are in the requirement above when you're reading it through, multiplied by the 40 ordinary shares. So again, just designed to help you out to break it down, and the conversion is higher than the nominal amount for redemption, so the conversion is preferred on there because it's more worthwhile. Then finally, we've got the actual market value of the actual loan notes. They've given us the actual formula on there as we work it through. And this is where you've got to get down in your notes that this is where you've actually got some other factors within the financial management exam that you need to be aware of, such as the annuity factor table. So that 4.917 there, to give us the future value, is 6 years at 6%. So 4.917, these are given to you within the computer-based examination. However, some of the formulas that we've identified as we've gone through will not be. There is a sheet actually on ACCA's website. I'll put it in the description of this video. Check it out. You need to be comfortable with what you're given in the exam versus what you are not. Because the final bit on there for the total convertible debt, we've got the market value per loan note divided by the nominal value per loan note multiplied by the actual total non-current liabilities on there. A small spelling mistake will live, giving us 21 million for the answer. The significant number of candidates selected option B on there, taking the floor value of the loan note rather than the conversion value. So when you see on here that we're looking at conversions, that is where you've got to take the conversion value rather than simply the actual nominal or floor value given to you in the question. Nicely moving on to, again, a different kind of question now on here for question 4. Notice I've only identified valuing shares, is it correct? And only having to actually answer one of them. So in relation to the information requirements for valuing shares, which of the following statements is correct? So as you go through any question that has is correct or one is correct on there, one of the answers will be completely, you're reading, there's no chance of actually getting that. And as you can see on my notes on the side there, I've put false, consider the external factors that will influence this. False for part C, they influence the strategy and the value. And finally for D on there, false, all information can factor into the value. Whereas the answer that they've given on here for part B, shares are likely to be mispriced when managers and investors have different levels of information on there. So this is where you can actually have how much is actually disclosed externally versus how much is actually disclosed internally. So this is efficient market hypothesis on there for your notes to get down to have a look back in your core text. So if you come down as to what it actually was referring to, so we've got the correct answer being B, access to and the amount of information released, information asymmetry, so that's linked into between managers and investors. If you haven't got agency theory down, another theory key in financial management, that are the actual managers working for themselves versus working for the owners of the company, the investors. That's where they've both got different actual aims from what they're doing there. The investors want a return on their investment. Managers want to receive their wages, their bonuses as a result, which may not be aligned to what the investors are wanting. Finally on there, we've got consider both rational and irrational investors that would use this information. So there are still benefits from the availability of a wide range of published information which can be used to value shares. So it's all about what information is out there, financial statements, annual reports, actual disclosures from the company, press releases. These all factor into the valuing of shares, and has it gone up and has it gone down? Coming on to question 5 now that they gave us in the report, and this is the last one on here. So in relation to behavioural finance, another key area of the syllabus, which of the following statements is/are correct on there? So when investors believe that recent share prices increase will continue, this can lead to irrational investment decisions by uninformed investors. And you've got to say, is that correct or not? Or you've got to think it's people hopping on the bandwagon to say, oh, can I make a quick buck here? So yes, that is definitely correct. And informed investors, so rational investors, can contribute to speculative stock market bubbles. Well, they're investing into the market, aren't they? They're putting their capital into the market. They want a higher return than inflation. So yes, they would contribute to it. So hence the answer for 1 and 2. But just try and think about it logically. Following the crowd, jumping on the hype and trying to gain from it, the momentum effect. Think about systematic, unsystematic risk on there from diversified portfolios, and also the investors themselves. Are they rational? Are they pragmatic in what they're doing, or are they just sort of throwing money at it and then hoping to just jump on the effect of it and to gain a higher return? The final point on there about the second statement is true, trying to time the market for a short-term gain here. So speculative purchases during stock market bubbles. So the bubble keeps going and going and going and going, so that they buy here, realize the gain, and then sell it before the bubble bursts. So hence, again, another correct statement on there, which then would nicely lead us on to section C, which I will do in another video. So I hope today's video has helped you through walking and talking through section B with 5 questions and examples, seeing the external examiner's reports along with those key formulas that you can get down in your notes. I hope you've enjoyed it, as I said, and if you have, be sure to give it a massive like and thumbs up from my mum's lovely kitchen on here where today's recording was done. Also, if you've got any comments, questions, leave it below. If you want any more FM videos, more than happy to help. And as ever, be sure to subscribe so you get access to all the free materials, just like Vidi, and this could be the difference in getting you the 50+ to pass your exam. Well, on that bombshell, we'll see you next time. Cheers!